It's 5 o'clock in London. It's midday in New York, midnight in Hong Kong, 2 a.m. in Sydney, 9 a.m. in San Francisco, and 9:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID live stream, Series 30, Episode 4 in the aggregate. That makes for episode number 178. Starts here. Lots of exciting things have been happening in the exchange world over the course of the last week. There's a fond farewell to Thoma Bravo, albeit we suspect they may be back. They have now sold out their entirety of what amounted at one stage to 7.4% of NASDAQ, selling a couple of huge block trades just the other day. May 7th, May 13th, they had a remarkable number of shares as trading. The last tranche selling at $80.68, closing out a deal from 2023 where NASDAQ bought the Adenza offering for $10.5 billion in cash and stock. Very handily when the company sold its two block trading blocks of, good grief, what was that? 17.33 million shares alone on May the 7th. They garnered $6.2 billion from an initial $4.7 billion stake. What a win-win, an additional $1.6 billion uptake. And indeed already Adenza is very well integrated into the NASDAQ empire. One huge piece of M&A this week, not huge dollar-wise, but very, very interesting strategically. Finally, something that I was talking about, good grief, 25 odd years ago, the idea of trying to unify different listings platforms that were looking towards, say, things like extractive industries and miners. It's not the London Stock Exchange, Johannesburg, Australian Stock Exchange, Toronto Stock Exchange deal that I thought might happen. Rather, the Canadian Stock Exchange, small but perfectly formed arm of the, well, how might one describe it? The Urbana Corporation's portfolio. They're the biggest shareholder in there. Tom Caldwell, of course, a very famous exchange investor. Richard Carlton, CEO of the CSE. He has grabbed the metal and he's moved forward and acquiring the National Stock Exchange of Australia. And as you can remember from this particular canon, all three of the gentlemen I've just mentioned were all previous guests on this show. You can catch their back issues at different, Farrago's 63, episode 63 was Richard Carlton, 173 was Max Cunningham, and we had Tom Caldwell somewhere just briefly before the Max Cunningham one, around about 150, if my memory serves me correctly. The producers will doubtless put me right in just a second. Frankly, NSX was cheap. It's a great tie-up altogether. Very, very exciting to see what's going to happen. At the same time, in the world of super liquid, a highlight of the week was the RMB yield curve being tweaked further. It's coming closer to being easily tradable in Hong Kong. Swap moves this week, a lot of lovely little rules and regulations being filled in. There can only be a huge fillip to the internationalization of the Chinese yuan and indeed the expansion of the Hong Kong Exchanges platform. Watch this space when they get into the yield curve of RMB and trading futures and options thereupon. Back to the antipodes for our final opening remark. The Australian bourse operator ASX, as we know, an organization which has hit rather, cynical times. Nobody seems to really trust it these days, alas, given the endless problems they've had with their own market structure, often of their own making. ASX are now, they're resorting to just cutting headcount. That old move, 8% cull expected. Sadly, it doesn't seem to uncover most of the C-suite, which might be where possibly there could be a lot of fat to be taken out. Whether ASX employs one person or a million, any variation in between, there's frankly zero faith in management to deliver right now, which is a huge problem. Our guest today, ladies and gentlemen, is the fabulous Mark Bettis. Our topic is the evolution of trading. Mark began his career in tech in the financial markets in Hong Kong quite a few decades ago when, frankly, tech was a very, very different thing. But nonetheless, it enabled the understanding of what drives today's modern markets. Mark evolved key roles shaping the future of markets, including developing the Hong Kong Stock Exchange options market, the first in the region. He worked for the Hong Kong Futures Exchange for many years. And then more recently, when he made the move to North America, he's been in the business of honing block trading with the BIDS platform, which he co-founded and was later sold to SIBO. Mark's achievements are vast and multifaceted, and he brings a fascinating perspective to the world of markets, and that's why I'm delighted to have him on the show today. Mark, welcome to the show. Where in the world are you today?
Hi, thanks, Patrick. I'm in Vancouver, in Canada. and it's 9 o'clock in the morning for me.
9 o'clock in the morning in Vancouver. Thank you for joining us over breakfast almost. Well, of course, it must always be interesting being based in Vancouver because you got to be up pretty early at all points in time to manage to see the start of those markets on the East Coast.
Yeah, it's basically a 6:30 start if you're going to be actively monitoring the markets. But over the years, I managed to squirm my way out of those early morning meetings every day and work a more civilized time. So this worked out very well. And I think of myself as the pioneer of working from home because I've been working from this office for over 25 years now. So I had a lot of practice at that kind of thing.
That's fabulous. So tell us a bit then. I mean, you started out in tech. How did you get into technology and indeed markets in the first place?
Well, yeah, I mean, in those days, working in tech in the financial markets was more about accounting and management systems and that kind of thing. And I did a lot of work with when VisiCalc, the original spreadsheet, was invented. I took to that like a duck to water. It was an amazing tool, and we used to use that a lot for financial reporting and analysis, and subsequently for risk management in the metals trading world. I joined a startup in Hong Kong in the early 90s trading aluminium and copper, or aluminum and copper for some of the audience. And that was a big use of the LME at that time. It was my first exposure to the markets to the liquid markets, and from that I learned about derivatives and options and futures, and it was I was a convert to never look back. I was already in my 30s at that time, but that took me into that world. And luckily, the Hong Kong Stock Exchange at the time was looking to develop its traded options market. So I was in the right place at the right time, joined that. We set that up, launched it. It went very, very well. And that I then became really a consultant to the industry. And that's what led to the formation of BIDS trading. The BIDS IP was created by myself and my colleagues here in Canada, and we managed to sell that to Wall Street. Basically, 12 bulge bracket banks bought the IP, and we set up BIDS in 2007. And I'm pleased to say it did very well, and it's now the leading block trading venue in the US. So that's been an amazing story.
Well, it's very interesting. It's quite a remarkable tale because you start in derivatives and you end up creating something that has been a huge boom to the cash markets, but at the same time is in inverted commas, most two-dimensional of all cash markets, the stock market.
Yeah, it's true. I mean, it's derivatives trading has a lot more sort of meat to it, let's be honest. The dynamics of risk management and the pricing tools, it's a fascinating world to be in. But all the more reason why, in coming to the cash markets, it was very interesting to try and do something that was different, because outside of the creation of electronic trading, which was pioneered in Europe and in Australia in those days, the US markets in particular, North American cash markets, have been held behind. And so when we were working as a team we were doing a lot of consulting work for all sorts of markets, not cash and derivatives. But when we came to the concept of the block trading, we found that the cash markets were not really served very much at all with innovation. It was hard to come up with a new idea that was going to work for them. And the one thing that we started looking at, in fact, was small cap markets and the problems of liquidity. How hard it is to find a contra party with a very thinly traded stock, and how easily you move the market if you're not too careful. And we came up with a way of managing those trades that tried to eliminate most of the obstacles of leakage, information leakage, and front running and that kind of thing. And we thought, okay, we've built this model now. Now, who do we sell it to? And of course, you look at all the equity markets that are potential candidates, small cap, illiquid markets. I mean, there's not a lot of money in that. You can build some fancy tools, but the revenues, may not be there. And so we thought, well, what do we do with this tool? And then it occurred to us that actually one of the most illiquid markets that you can get is in block trading of even liquid stocks, so that you have, if you want to trade enough millions of shares of Microsoft, there comes a point where that's not available. Liquidity is not available. Mm-hmm. So we thought taking it to the biggest market in the world kind of solved our problem. Number one, we'd have these tools that could facilitate liquidity in the manner we had intended for the small cap markets, but at the same, but in a market which was actually very big and potentially lucrative, and that was the U.S. block market. And it so happened our timing to come into that was just right. 2007, the big banks were beginning to recognize that through the ATSs, a lot of liquidity was moving from their desks to their competitors, and they jumped at the chance to work with us, and we set it up from there. So in the end, the fun of working with derivatives, I missed out on that. But this new challenge was just as interesting and just as rewarding. So it worked out well.
But it's very interesting, isn't it? Because you look at the way that things have moved over the course of, your career. You sort of blazed through being in Hong Kong, and it was a great review. But actually, when you started in Hong Kong, there were 3, 4, 5 stock exchanges. I mean, they were only rationalized a few years later in the mid to late 90s, if I remember correctly. Then you had the Hong Kong Futures Exchange, which you also worked for, and then that was also absorbed into the HKEX group. But it's a very interesting process to look at how technology was being used, say 30 years ago or 25 years ago, to where it ultimately went. And in fact, how the leadership of that technology has changed over time.
Well, yeah, that's an amazing story if you think about it. When I left Hong Kong and moved to Canada, which was just a personal decision to relocate to North America, family reasons and so forth, I arrived here, and the ECNs had begun to make their presence felt already at that time. But if you looked at the way that stocks were traded in the US, compared to everywhere else that I'd observed, especially in Europe, they were really a long way behind. I mean, the technology just was pretty primitive. The focus was still on floor trading. This is true in the derivatives as well. And to see and to come from working with people like Eurex, and observing the way the ASX ran its options market in those days, and seeing how the US model worked, it was quite surprising to see how far behind they were. But roll ahead, less than 10 years, and the whole landscape had changed. I mean, once the technology had taken hold, people ran with it in the US. And I have to give the credit to the regulators in the US, particularly for the way that they were willing to support the ATS landscape. The ATS as being the more lightly regulated exchange operations that the SEC allows and still does support to this day. In the exchange world, it was pretty hard to innovate. With ATSs, you were much freer, and there wasn't even a specific approval process where the SEC had to approve your license to trade. It was more, or approve your rules at least. They more or less said, okay, you can set up, you can operate, and just notify us when you make changes to your rules, and that allowed a flourishing of new technology, new ideas, and now the whole thing is upside down. If you want to look at innovation in the equities world, you look to the US. I mean, the number of ATSs that have grown over the years with different trading models, different pricing models. It's all been very helpful, and I have to say that I think, regulators in other parts of the world, Europe and in Asia, I think they could really learn a lesson from that in maybe letting some of these flowers bloom rather than being over concerned about having control, which I'm afraid too many regulators have that mentality.
It's really fascinating when you look at the size and the growth of the electronic US equities market. I mean, it's not just the fact it's become 61% or whatever of the world's global market cap, which is a staggering statistic in recent years. It's just the sheer breadth of it blows my mind.
Yeah, and it's absolutely true, and I think you've observed, in your newsletters, the way in which, I mean, it's public knowledge, the problem with exchanges outside of the US gaining listings, new listings. It seems that any business that has any kind of international reach is increasingly defaulting to listing in the US. So I don't know where this ends. I mean, right now it's very good if that's the market you're operating in, and if you look at the way that's going with the with the Asian hours trading that's now really booming. Asian investors trading in their time zone, trading US stocks. There are days when the number of the volume traded of those stocks in Asia is bigger than some of the major exchanges out there. That's already happening. So who can say where this goes? I mean, in recent times, there's been obviously politically there's this stepping back from the US, which is in response to all the tariff talk. But whether that will translate into stepping back from the US equities as a trading venue, I don't think so. I think this trend is pretty entrenched, and it's something that exchanges need to address, and they know that. Of course, don't need me to tell them that.
Well, it's incredible when you look at it. I mean, over the course of the last 6 or 7 weeks, I mean, the last time, actually, I was on FinTech TV earlier today, and the last time I was on FinTech TV just over a month and a half ago, was before we set off on a massive tour of Southeast Asia. And that was hilarious because at that point in time, you had a lot of, frankly, clickbait monsters of digital media were all telling us it was the end of the world and everything was going to decline. And yet you actually got to Southeast Asia, and I found it was a much more measured response to what Trump was doing, even if nobody understands quite what he's doing. People just still wanted to do business. And then I get back here to Europe and discover that, America has managed to right itself. It's back in new high territory. It's been quite the most incredible month in that sense.
Yeah, it has, hasn't it? I mean, you have to acknowledge that anyone's ability to analyze this and conclude, okay, this is where this is going to end. I mean, it's never easy to do that, but especially so in the current environment. But of course, that's all it's all good news for people in the equities business. Let's face it. I mean, this volatility that's followed from all of this it's faded a bit over the last few weeks, admittedly. But again, if you look at the volumes, they're really holding up extremely well. So the market, as always, is doing its job, and this again is one of the things. If we look at the way that things have evolved over the years, the reliability of the technology now is is amazing. I mean, the expectation is that you will have 100% uptime if you operate an electronic exchange, and there's no tolerance for losing even a single minute of that. And look how well the exchanges have handled that this year, and you know, frankly, throughout the last 15 years, really.
Yeah. It's actually quite hilarious because we get these sort of amazing exposés by some of the wires who probably are written by people who just didn't experience life even a decade ago. And it is remarkable because you can remember how often when we were floor trading, there was actually large amounts of time when nobody was trading, largely because Reuters or that new upstart at the time, Bloomberg, their feed went out and therefore nobody really had any idea what the news of the prices were from other markets. So your market didn't actually tend to trade. You all sat around in the pit and had nothing better to do until there was a live series of news feeds around you. I mean, that was prevalent, whereas now everything works pretty much all of the time.
Yeah, absolutely. Well, that reminds me of an amazing story, which many people will remember, but I think it's worth retelling. You'll recall, I forget which year it was, but you know, over 20 years ago, when the London Stock Exchange system went down, and there were no, you know, they couldn't trade, and it was, I believe, it was on the day of the last tax day of the year, or like awful, like the worst day of the year to do that. And there was at that time in London there was a startup electronic exchange that had only begun trading in, you know, a few years ago, and was trying to establish its reputation. And it was a pure electronic exchange. People had access to it. They had members. I'm trying to remember the name now, Patrick. You might recall. Was
it? It was something Point. Was it Trade Point?
Trade Point. Yeah, I think that was the name. So that was a plucky startup, and I remember thinking, well, their day has come. Now they can really make an impact. They're open for business. Everyone can trade on Trade Point, and that'll be great. And they got no. It was just another day for them. In fact, it was worse than usual. And the whole problem was what you pointed to was that there was no guidance, there was no feed, no underlying feed, and so, you know, people, even though there was an exchange to trade on, they didn't know where to go, and there was no market making facility on that exchange, on Trade Point, and so it died a death. So that was a really big lesson to me when thinking about how do you start how do you establish a new exchange when you're the new guy on the block? What do you have to do? And the lesson I took away from that, not so, was that you really had to work with the existing infrastructure, with the existing rules, with the world as it is, not as you wish it could be. And what that means, it means that not only can are you going to be reliant on the incumbent exchanges for your price references, but you're also going to be reliant on the established infrastructure for your participation. And I think, bringing that back to the bids story, that was the lesson there, was that with this business model that we built for bids, rather than us going out and trying to raise whatever it would take to start a new brokerage and to sort of gather clients together and get the thing going, it was going to be a very expensive enterprise. That was why it occurred to us the better way to go is to work with the existing players and have them as your partners, and meaning the existing brokers. So you come into the market ready, with a ready-made source of liquidity. And I think too many startups who want to break in and want to make their presence felt don't really learn that lesson. And when they try to go it alone too much, it can fall apart. And there've been some sad examples of that in the US over the last 10 or 15 years. I think the ones that have succeeded are those who've worked with the brokers, with the sell side, rather than against them.
And there have been so many, I mean, in the early days, somewhere between the time we went from ECNs to ATSs, there were some fabulously interesting ideas that people were putting out there over how to manage to match liquidity in a way that ultimately just didn't take place. And there was, what was that? Was it the Arizona Stock Exchange or something that somebody posited at one stage? I mean, such great ideas, but they just never gained traction.
Yeah, no, that's a good example. Actually, I believe that was they were working on an auction model, and again, that is the auction model is an idea that's come and gone. I almost think since time began, it's sort of pre-technology. The idea that rather than you opening the exchange for from 9 till 4 or whatever your hours are, that you just have single auctions, like you just have one at maybe 9 o'clock and have another one at 11 o'clock and so on and so forth, and that you focus all of that liquidity into those times. I mean, it's a great idea, and the logic of that, you had things like Optimark, which was another great innovation, that with this idea of gathering together everybody's trading wishes and then consolidating them through a very, through a clever algorithm so that maximizes liquidity for everybody. And that never worked, and there's been several examples over the years. I wouldn't be surprised if someone's launching one now as we speak. And I think where it's gone wrong is, especially with the advent of technology, is you can't stop people from trading. They just want to trade, and and we see this with the advent of the so-called 24-hour trading, where if you ask most of the practitioners who are in the field, they really don't want it. No, I work hard enough already. They think, and we don't need to add to it. And yet, it happens, and people do trade. They want to trade after hours, and they want to trade all sorts of times today. And as I said earlier, with the 24-hour thing, that's really an Asian hours trading idea more than a 24 hours trading idea. So the point is that it's very, very hard to you're going to get that fragmentation, unfortunately, unless you ban it. You can regulate your way out of it by just prohibiting people from doing those things. But if it's a free market, then that's the way it's going to go. I mean, you do get the concentration on the close. That is a form of that is literally the closing auction. There's been a greater and greater trend towards that as a proportion of the total day's trading. But if you remove that from the picture, ignore the close, the intraday volumes are still way higher than they were, 10 or 15 years ago. So those new ideas for new trading models, some of them can take off, but they have to match the wishes of the incumbents, and I think that's where those models have had a problem.
And that's the interesting thing, about the American experiment in equities and also to a degree in options, which is we seem to be just adding MTFs all the time. And provided you've got some sort of coherent spin-off model that specializes in something that the others don't do, you will actually get a reasonable amount of business in this mega market. And therefore, that's why we're up to whatever it is, 30, 40, 50 MTFs, all doing all sorts of little tweaks around about. And also, of course, some of them breaking completely new ground, as you've said. We had Bran Heinkman on here a number of months ago talking about Blue Ocean. And that has only gone from strength to strength, as you say, thanks to Asian hours trading through the night. It's fascinating. It seems to me it's more a case of not reinventing the wheel or building something incredible, but actually finding a little niche in the US market, because the US market is simply so huge that can deliver you a remarkable amount of fee income.
Yeah. So I think many of these innovations I think, that have occurred, or the growth, even without innovation, I think it's a lot of it has sprung from the way that technology has enabled data to be generated and digested and then used to create new models. Now, there's really, I think there's two different points here, but I want to come back to that one in just a second. Yeah, I think in the case of the ATSs, that a lot of the innovation has been around institutional trading. So a very good example is PureStream, which launched in the US a few years ago now, where they really turned the VWAP data almost on its head and said that rather than us writing you an algorithm that will give you a certain percentage of the VWAP trade. So your goal is that you want to get this done over the course of the day, this block execution, and you want to do it by participating in the minute-by-minute trading at a certain percentage level. So I want to have 10% or 15 or 20% of it. And I must say, when that model first came out, I mean, most people's instinct was to say, well, people don't trade that percentage of the VWAP because that's what they literally want to do. They do it because they have to do it, because if they do any more than that, they will move the market too much, or they'll fall behind and won't get enough done. And yet PureStream came and said, no, well, actually, maybe this is an alternative way of you achieving that goal. And sure enough, it worked. It was very clever, and I think they've done very well. So that I think was like creativity, at a higher level of thinking, not utilizing the tech. But I think where the technology, the improvements in data distribution and the sheer ability to process all of that data, where that has really come into its own, I think, is that it actually has generated massive amounts of liquidity all on its own, and in a way, therefore, I would say the quant funds that started coming into their own 20 years ago have actually, I think, created a whole new set of liquidity opportunities. And they didn't do that because they're trying to provide liquidity to the market. They did that because they had machine learning algorithms that generated those orders. And so a huge chunk of the liquidity that's available today is driven off the back of that tech-driven quant trading, and it's now becoming more and more dominant. Now, people don't tend to think of the quant firms as innovators in the world of liquidity provision or exchange trading models, but really they have had a huge role. I almost feel like the primary role in building these liquidity opportunities that are available today. So, and there's more of that to come, of course.
And you mentioned there the whole concept of creativity at a higher level of thinking. And I'm going to therefore give you a brief break, Mark, because that point in the show where we go and look at a little short video and we also talk about our books of the week. But talking about creativity at a higher level of thinking, well, we'd love to think that that's how we think about Exchange Invest, because 12 years ago, Exchange Invest, which is, of course, the publication that manages to fuel IPO-VID and subsidize it into existence, Exchange Invest launched with a bold idea to be the exchange of information, the daily digest and analysis for those shaping the world's marketplaces. What began as a niche missive is now the daily read amongst global bourses, central banks, fintechs, and beyond. We'd like to say a huge word of thanks to our brilliant subscribers, readers, partners, and exchange aficionados. You're the reason we've been the water cooler of the bourse business for the past 12 years. And here's a short 1-minute video to celebrate.
In 1940, 60% of today's jobs didn't exist. In 1970, 90% of today's markets didn't exist. Exchange Invest embodies the capital market revolution. We're the only daily pithy analysis devoted exclusively to the business of bourses. On our 12th birthday, our track record speaks for itself. Exchange Invest is the exchange of information. Exchange Invest champions markets, and yet, while we've enjoyed a half-century of unprecedented market growth, we're barely in the early stages of bringing more liquidity, accessibility and transparency to drive prosperity around the world. 90% of today's markets may be barely 50 years old, but we still have 90% more markets to launch. What market are you going to build in the age of the exchange? On behalf of the team, thank you to all our loyal subscribers and sponsors for their support over the years in helping us deliver unparalleled insights for the markets of today, looking to the exciting world of the markets of tomorrow. This is the age of the exchange. Happy birthday, Exchange Invest.
Taking the age of the exchange forward, let's just catch up with a few of the books of the week that we've had in Exchange Invest Weekly recently. You can catch, of course, the Exchange Invest Weekly is an entirely free newsletter about sort of macro issues more so than the minutiae of the bourse business, although do please subscribe to Exchange Invest at exchangeinvest.com so you too can join the water cooler of the bourse business, the exchange of information, because apart from anything else, it subsidizes the making of great videos like this today, where we're talking about the evolution of trading with Mark Bettis. Anyway, a series of books that we've had as our books of the week recently. Alistair Nairn wrote a fantastic book. It's in a great second edition now. Engines That Move Markets. Really is a must read. That is a true heavyweight book in every possible sense, but thoroughly exciting to go through. Smaller tome, but nonetheless very thought-provoking. George Soros, at the peak of his investor powers, he produced The Alchemy of Finance, which is always well worth having a read at. Sir Paul Collier was a fabulous guest on IPO-VID just recently. He is, well, from the UK to the world, probably one of the world's leading developmental economists. It was a joy to chat to him. One of his books, which we picked out recently, is The Bottom Billion, Why the Poorest Countries Are Failing and What Can Be Done About It. An absolutely fascinating read there. And last in this clutch, as we catch up on different books of the week, The Death of the Gentlemanly Capitalism. Philip Auger looked at the City of London as all sorts of things tore apart the old-fashioned market and internationalized the City of London to lead it through the era of Thatcherism into an incredible deregulated enterprise, and indeed 20, 30 years of incredible prosperity, and in many respects, London being a leader in the equity markets and the derivatives markets in the world, something which has only started to somewhat peter out in more recent times after a series of, well, governments which make you wonder how on earth they can possibly have managed to occupy the same residence 10 Downing Street as the great Margaret Thatcher. Anyway, those, ladies and gentlemen, catching up with our books of the week. Let's get back to Mark Bettis. We're talking about, well, a fascinating discussion, the evolution of trading. We've been through all manner of things. One thing, Mark, I wanted to just pick up on. I mean, we talked about how much has been going on within the equity market itself recently and how that's been developing. You were talking about somebody like PureStream, a great example of a very successful platform. Something which is both good but also to me a huge concern, the draining of liquidity from the markets through what is essentially bilateral dealing away from the exchanges. Where are you on that sort of debate, and how do you think that trend is going? Because I personally am quite worried about price discovery.
Yeah, no, that's a legitimate concern. I mean, what's happening here is it's really grown a lot, literally over the last 18 months to 2 years. So just to give some background to this, when BIDS started for its initial phase, principal traders were not really welcome. The perception that existed amongst the institutions was that the prop traders were out to gouge you, to front run you, basically not safe to trade with, and I don't want anything to do with them. And that was legitimately true in a lot of cases. But as you fast forward and you see that the way in which the big prop trading firms, like Jane Street in the US and Hudson River and Europe, XTX and these Optiva, these people, the way that they've evolved is they've become in some respects quasi market makers, not necessarily initially out the goodness of their heart, but just as a byproduct of the way that they trade and the provision of liquidity that they give. So what to sort of bring that into the present day, the point you're referencing there is this trend for those firms to, instead of sitting there as passive players waiting for the other side to come to them, they're actively promoting the idea that they should be liquidity providers in their own right. Now that and are gathering customers off the back of that plan, and that's happening. So yeah, your concern there, of course, is the way that trading is being done. It's being done in the dark, essentially through not off exchange trades, but off book trades. They're not part of the lit market, and the only time the exchanges see them is when the trade is printed, and they report that into the exchange, as they're obliged to do. So the concern is that as more and more people, not just institutional but retail investors as well, as has been happening with payment for order flow for some time now, is that eventually the lit markets dry up. There's just nobody's posting anything there because they're all doing it through these firms. I think the way that problem will get addressed is that, like I was saying earlier on, there are people who want to trade all the time and trade, or want to trade when they want to trade right now. And they will look to the lit markets for those prices. Now, will the prices be there? I think yes, they will be there, because the exchanges will mandate that market makers do provide prices there. That's part of the game, and so those market makers will be taking their cue from the trades that are printed to the book. Remember, these off book trades are, they're reported as soon as they've happened. So there's a constant stream of data about real actual trades that are being executed. So I think the market makers adjust their quotes in accordance with that. Now, you add to that the fact that there's, like it or not, institutional traders feel they have to trade VWAP. There's this horrible fear of getting a worse price than the VWAP. That's like an embarrassment to them, shall we say? And so the only way in which those VWAP trades can get executed will be, again, to go, not the only way by any means, but the one important way will be through algorithms that go through and hit the lit market in that way. So I think there is a risk that the lit markets become a bit shallow, right? In terms of, if you look at the book at any point in time, the depth of book will maybe not be as big as it used to be. But but really, as long as there is a reference price to trade against, then that depth will be available to people. Either, if it's not available on the lit market, it will be available through these other sources. And so, yes, I think lit volumes will potentially decline, or at least as a share of the total. Well, in fact, they have been declining for a long time. But maybe that will continue, but I don't see it going away altogether. For one thing, like I said, I don't think regulators would permit it.
So it's very interesting. You don't think regulators will permit that to all go away, but nonetheless, it has been a very, very rapid change over the course of the last 18 months, which is quite rare. How do you see the development of other areas of the market? I mean, obviously, one thing which was spectacular was to see Thoma Bravo, as I headlined at the top of the show, knocking out, several percent of NASDAQ over a couple of days, which is absolutely, fantastic for the block market to see blocks of that size taking place.
Yeah, that was remarkable. I think it was 43 million shares or something?
Yes, something like that. Yeah,
something like that. Yeah, that's a huge trade, huge. Now, whether that was all done in one go with one counterparty or how, I don't know. It'll be interesting to find out. But yeah, I think for those kinds of trades that are that big, I don't think there is a single technology that facilitates that. I don't think so. For example, I don't think we would have seen that go directly through a platform like BIDS as a single trade. I think probably it's the kind of thing that has to be done, over the phone and with trusted people, and with a fair amount of setup. And in fact, we have seen that over the years. I mean, when BIDS first started, it was not unusual to get a 5 million share trade go through, or even more. Over the years, that very rarely happened. The availability of single large block executions through the platform has declined. Total volume has gone up, but I think that's just reflective of the way that when you want to trade a block, there are many ways of getting that execution done, and a single large print is only one of them. So I think that will be. I don't see that trend changing. I think print sizes are they're not going to get any bigger. Let's put it that way.
Yeah, well, it's very interesting, though, but that again goes back to the core thesis of what's happening is we're getting this endless number of series of specialized shop fronts, for want of a better description, all making up the massive number of ATSs and the exchanges themselves, which are offering 1,000 different varieties, or at least certainly the Heinz 57 varieties of trading in all sorts of different ways, and therefore enabling blocks through a multiplicity of ways, apart from just huge lumps of stock. 43 million shares, 7.4% of NASDAQ traded in a series of blocks on 2 days. I think it was the 7th of May and the 13th of May. We await regulatory filings to see whether somebody was picking up large chunks or it actually got distributed into the market. But either way, the fact that it was possible to do with relatively little market impact, cents here and there on the share, nothing more, is incredible.
Yeah, well, that's the great thing about the different models now that are available. I always thought one of the simplest tools to enable this has been the simple midpoint execution. The reason that large blocks move the market in the lit markets is that most of those trades are happening either at the offer or at the bid, and that's just a flat out signal to the market that somebody's either a buyer or a seller. Whereas if you do a midpoint execution, that signals nothing. You don't know what direction that's going in. And so that's where these now the lit market doesn't really support that. By definition, you're not going to have a midpoint bid sitting there because it won't lit, because there's won't be midpoint anymore, right? It will move the actual bid or offer. So. I think that the ability of the new platforms, well, not new now, but the ones that have evolved through the block market ATS system over the last 20 odd years, it has done its job. It really has done its job, because previously there was not really any way for you to, if you were going to trade a block, you had to announce it to somebody. Yeah. And that's no longer necessary, and that model's been repeated all over the place, and it's I think it's robust and it's going to stick around.
And it's also very interesting how that. In London they had, for example, the equity IDBs and indeed the bond IDBs, which, the equity IDB structure was essentially a way for market makers to trade somewhere inside a massive spread. So instead of spread trading inside a 10p spread, they trade a couple of p inside, but they could trade with other institutions. But you were always leaking effectively information on where you're going. I think midpoint match is such genius because it reframes the whole concept, because actually you can't say person X was selling because actually they're not pushing the market one way. You actually have to say, there's a new institutional shareholder in company Z, and they now hold X percent of that stock, which in many ways is a suggestion that, well, it's a lovely refurbishment and a move forward. It's progress, because now we've got a new lovely bright-eyed and bushy-tailed institutional investor who's obviously keen to have that share for the future.
Yeah, I think that's fair. To an extent, the actual participants in the market are going to know. If you're a prop trader and you've got a midpoint, you've just done a midpoint trade, you can make a fair guess maybe that was an institutional trader on the other side of it, but it may not have been. It may have been another prop trader with a different market view and a different reason for wanting to trade at that level. So I do think it's there's probably never an absolute solution to this problem of moving the market with a very large block trade, but I think we've got great tools for dealing with that today.
Yeah, and certainly the one thing that's very, very interesting, going back to the macro, is that we've got all this very, very interesting granular development, but at the overall stage, I mean, the force of technology is just moving markets forward inexorably.
Yeah. No, I mean, and this is the most fascinating thing. I mean, I hate to sort of make the obvious cliche about AI, but the reality is that, especially when these AI agents get out, that actual tools that are using AI with a particular purpose in mind, I think the ability of tech to be delivered to the end user in an incredibly sophisticated manner will be there. If you look back at the quant funds and what they've been doing all these years, really they were a precursor to the large language model. I mean, it was the same thing, same process, identifying patterns, but not in words as with the AI language models, but in market data, pure market data, and looking for patterns and determining how they will be sustained. Now, so that was kind of the same model, but it's been applied to market data for many, many, many years. We called it machine learning back then, still do, I think. So when you start thinking about how that could be brought to the individual investor, sitting on his Robinhood phone or his Interactive Brokers account, the ability to actually use those things to generate orders, and strategies out of that analysis. I think that day is going to come. I wouldn't be surprised if somebody's already working on it as we speak. But what that will do to individual investors and their ability, and frankly, maybe institutional investors as well, obviously. But the broadening out of it to a much bigger and bigger constituency suggests to me that there's even more growth ahead. You think these markets are amazingly busy today. Imagine what they'll be like when that intelligence can be applied at the end user level.
And that brings us beautifully to a question. We got a question from Amit Desaya. Thank you very, very much, Amit, for your question. Hi, Patrick. How do you see the US implementing 24/5 trading hours? It impacts on retail investors and middle office operations people working in the settlement side, he asks. Well, Mark, I mean, you've worked on both sides of the fence. You understand how this works. How do you think about it? You've been talking about the US move towards 24-hour trading or Asian hours.
Well, I think from the sort of admin end of it, the middle office and back office, I think the impact on that will be relatively minor because that whole process is already fully automated. I mean, nobody goes around, to brokers' offices delivering their purchase and sale tickets to each other and manually processing them. Literally every single trade is processed in real time and at day end cleared through a totally fully automated process. So the fact that there's more of it that needs to be squeezed into fewer hours, I think at one time that could well have been a devastating processing problem, but I think because of the degree of automation, I don't think it's a problem. From the point of view of retail investors, I kind of see the point that if you're actively monitoring your positions, you're trading online or on your phone. In some regards, maybe it's a bit of a relief when 4 o'clock comes and you don't have to be looking at the market anymore. But that the fact that we're all kind of, welded to our phones and looking at stuff in real. I mean, you all know people who send out chat messages at 2:00 in the morning when they should be asleep. I think it's the same with this, is that people will take to it and actually will kind of want it. Once it's there, once you can trade at 9:30 at night before you go to bed, you kind of want to do that. If somebody said, "No, I'm taking that away from you," you probably say, "No, don't take that away from me. I like it." So I think, rightly or wrongly, I can see the case against it, socially and everything else, but I think, the evidence we've got says that people will welcome it and that they will just trade. But like I said, the big thing with the 24-hour stuff is more the Asian investors themselves trading in their daylight hours. I think that's the real issue here.
Yeah, it's like foreign exchange, handing the book around the world rather than it being a case of insomniacal people in different parts of the world wanting to trade 24 hours a day. Very, very good question, Amit. Thank you very, very much for that. Mark, we've been discussing the evolution of trading now. Gosh, time has been flying by for over 56 minutes. So we've reached the apotheosis of the show. Mark Bettis, where do you think the capital market revolution goes next?
Well, I think everything that we've been discussing here points to, technology reaching out further and further into the community, if you like, into society, and that I think that the retail investor will at some point want to start asking the exchanges and the brokers to continue to cater even more to what they want. I'll just give you one simple example. To my mind, it's kind of odd that an options contract is for 100 shares, right? And whatever the share is 100 shares. I can imagine there's a lot of people would like to trade an option on 5 shares of Amazon or Tesla, right? And you can't really do that today. But why can't you do it? I can't think of a real solid reason why that can't be done with today. I mean, you've got to change a lot of laws and regulations would have to change, but that kind of thing is doable. So I think the technology will be an enabler of that kind of micro change to especially benefit the retail investor. That's one thing I would look out for.
The incessant growth of the retail trader and the opportunity to hone the offering of exchanges to them. A fascinating concept, Mark Bettis. Thank you very, very much. Mark, it's been a joy. We know that you've been a fellow revolutionary for all of this time. You're probably ahead of me in the revolution. I just happened to write the book. The evolution of trading has been a terrific show altogether. I hope that we can get you back at some stage to talk about this a little bit more, because it's been such an interesting discussion. I think certainly creativity at a higher level of thinking is something which I would applaud you for at all points in time throughout the course of your career. Let me just say, ladies and gentlemen, there's no show next week because it's Memorial Day weekend, and also actually I am in Yerevan in Armenia for the FEAS conference. I hope I'll see you there. I'm giving a keynote speech as well as speaking at the Copernicus University annual FinTech conference actually next week as well. So it's going to be a busy week for me in the wake of Memorial Day weekend. Who knows what will happen to the Penskes? I see they're on the naughty step at the moment. Only remains for me to say a huge word of thank you. Thank you, Amit Dosaya, for that fantastic question. Thank you to our production team, to Kim, to Jamil, and most of all to Natalie, ladies and gentlemen, because it's not often we talk about ourselves in this show, but let's say, Natalie and JB, congratulations on your wedding recently. I hope everything is a huge success, and we're sending you lots of love, everything working out well. Delighted to see you back in production too. Ladies and gentlemen, this has been a fabulous show, The Evolution of Trading with Mark Bettis. He brings us to the end of tonight's IPO-VID. My name is Patrick L. Young. Get in touch if you want to read Exchange Invest, the bulletin of the Bourse Business, or indeed if you've got an exchange or marketplace you'd like to get built, let us know. For now, I'm wishing you all a great week in life and markets. Thank you for watching.